And one today, without fail, 40%. Brian, what do you make out of these numbers?
Well, seeing how difficult it is to not be able to get internet access nowadays, it seems like the vast majority of all our respondents would get updated on share prices every day, if not very, very often. There is nothing inherently wrong with getting updated, but what comes along with these updates is that you get a lot of market noise, a lot of short-term market noise, and the danger with this short-term market noise is you run the risk of overly focusing on the trees, which is the short-term noise, and missing the forest of long-term investing.
Would it be your view, perhaps you should get a proprietary information system?
Yes, those are very useful, but unfortunately they do come at quite a steep price. For most investors, it would not justify the cost, but for institutional investors, they are a great source of information.
Yeah, but the guys that we interviewed sound quite level-headed. 40% of them said once a day without fail. Is that good enough, once a day?
I think that is good enough. It also depends on whether you are trying to trade the market on an intraday basis, but for most long-term investors, that probably is a bit too much. In fact, we tell clients one practical way of staying focused on the long term is don't look at share prices every day, because if you do look at that, the temptation to come in and start trading the market or doing knee-jerk things when the market makes a move like last week is very strong. Humans are hardwired to want gratification, to want results instantly. So long-term investing behaviorally is already very difficult. So we tell clients, don't look at share prices. Instead, spend that time doing something that you'd rather be doing, like spending time with the family or work.
We are joined by Mr. P. Mr. P, you have a question for Brian.
Okay, my question is, what's a good and a bad mutual fund? And how do we find the difference?
It's really important to look at suitability. A good mutual fund is designed to do what you would want it to do for your portfolio. So, for example, if you wanted to have an aggressive position in the equity market, then a good mutual fund for you would be one that would take more aggressive positions, one that would maybe look at more concentrated positions of smaller, more aggressive companies for longer-term growth. If your position was to be more defensive, then a good mutual fund for you would be something that would have more defensive assets, for example, fixed income. So it really depends. There's no good or bad product. It really depends on suitability for an individual.
And speaking about suitability and positions to take, what would you recommend for somebody now in these times so volatile?
Yes, there's a lot of volatility in the market. What we would recommend people to do is remain invested because volatility happens, but you cannot predict when it will happen. In fact, we would see this as an interesting buying opportunity. When volatility strikes, and you won't know when it will strike, but as long-term investors, we should be using these opportunities to pick up quality assets on the cheap.
669-11938 is our number. We're joined by Angela. Angela, do you have a question for Brian?
Yes, I have a question. My son is 17 years old, but he asked me to open a trading account for him. I was a bit too young to start trading, I think, but he's influenced by all his uncles and relatives. So do you have any advice as I try to guide him on this kind of investment thing?
I think he needs a lot of advice. Let's ask Brian.
Yes, morning, Angela. I actually started looking at the stock market when I was about his age as well. And because as a result of that, I've actually been through 3 market cycles, went through the dot-com, and then the SARS crisis, and then the great financial crisis. So actually, the earlier you start, the more experience that you build up, and there's nothing like building up experience when it comes to investing. So we would actually encourage him to start being interested in the stock market. Opening a trading account, you may want to set limits on how much pocket money you need to trade. Don't, of course, give him your entire family wealth to do that at such an early age, but make sure that there are controls in place, because you can put a lot of orders in, but you may not have the funding in your account to pay for that.
Angela, sorry, does that answer your question, or do you have a follow-up?
I want to know also whether there are courses that I can, send him to even understand the basics of trading in the first place and what he's getting himself into.
Okay, would you not rather have him understudy his uncles?
No, I don't think those are good examples.
Okay, let's put that to Brian.
Okay, sure. Actually, one way you could start him off with courses, basic economics course, so understanding how market movements are affected by what's happening in the world.
Get the fundamentals.
That's correct. Start with fundamental analysis, understanding how the world works, and then after that, a basic business course, because stocks are actually little pieces of businesses. So if you want to look at the fundamentals, you must first understand how businesses work. So that would be really your base. And then following which, doing a program like this Chartered Financial Analyst, the CFA program, that would form a very good technical add-on onto your basic.
You can do that at 17?
Yes, you can. You can start studying on your own.
Sure.
Just that in order to get certified, you do need some work experience. But it's a 3-year process and it's quite tedious.
Thank you for joining us this morning on Sense and Sensibilities. We're right here on 938 Live. We'll talk to you next week.
See you.
938 Live gets you talking.